Welcome, everybody, and thanks for joining us here today for another edition of the OIC Monthly Webinar Series. My name is Ed Modla, Executive Director of Investor Education at OCC. And as I see a lot of people still rolling in, just a little bit about my background. I started in the industry back in the late 1990s as a professional market maker on the trading floors of CBOE and the Chicago Mercantile Exchange. Also spent some time in New York. Bounced around the industry, both from a trader's perspective and a broker perspective, until landing with the team here at OCC back in 2014. So going on 7 years now, strictly providing education to all market participants that are interested in learning about the options product. That's what we do here. And my colleagues and myself absolutely love our place in the industry to help investors understand the benefits and the risks of the options product. Today's topic is understanding options collars. First, let's take a look at our disclaimer. Options are a rather complex tool that needs to be well understood before using in a live account. And a little bit about OIC. We were founded back in 1992, more or less as an industry cooperative, an entity that did not sell anything. We don't have brokerage services. We don't sell data. We're not licensed to provide advice or guidance. We are strictly here for the sole purpose of providing free, unbiased education. We are able to do that for free because the Options Industry Council is provided to the industry by OCC, the clearing corporation, all those little fees that are attached to trading options contracts. Some of those come to OCC, and off of their working budget, a certain portion of that is allocated to the efforts that we do here at the Options Industry Council to teach about options. So our users can do so without feeling any pressure that they're going to be sold anything. They have nothing to sell. You can find us at optionseducation.org, where you have plenty of material in different formats, written courses, audio podcasts, past videos, webinars, just like this one, archived, that you can find on our website. If you have any questions about where to find a particular topic, you can email our team at options@theocc.com. We can also answer questions about options. As long as we're not in the position of giving you guidance, we can answer from an educational perspective some of your questions. Speaking of our team here today, I have a few fellow OIC instructors live behind the scenes. Mark Benzequin and Ken Keating are here to answer your questions. So please don't be shy about sending those questions in. Mark and Ken will be answering them live throughout the presentation. Any questions that the two of them cannot get to today during the presentation will be sent a response by email. So if you don't get an answer in real time, keep your eyes open for an email to come from the team, as we do respond to all of those questions. Take a look at an outline for today. It's going to be a little something in here for everybody as we start with the more simple strategies of protected puts and covered calls. Many of you are probably already familiar with those strategies. We'll look at them from a basic perspective and cover the construction, the risk profile, and also maybe a little bit more deep into some concepts regarding those two strategies, and then we'll put them together into the collar strategy. One thing I like to do whenever I talk strategies is to also include a discussion on variations of that strategy, and that's what I'm going to do here today. When we talk about option strategies and we say strangle or straddle or butterfly, that's helpful and useful to get us all on the same page of what we're talking about, so we all can use that common language. But in a real live account with real money, it's frequent and often that investors will take those classic constructions of the traditional strategy and then tweak it in some way to tailor the strategy more to their liking. And so we'll do that by looking at the collar variation. Starting with protected puts, as I said, this is a rather simple strategy that we'll get started with. It has two pieces, two sides, and before we get to that, let's take a step back to more, options 101, options basics, where options holders, any option holder or buyer, has paid cash upfront, non-refundable cash debit for the privilege of owning rights, while the sellers take on obligations. In the case of puts, the put buyer has the right to sell shares at the strike price of the option. That's what they have paid for. And that's what the premium that goes to the seller is for the benefit of this right to sell shares at the strike price. Now, by itself, buying a put outright is considered a bearish strategy, and the investor likely has no interest in exercising this option. If they were to exercise a put, the buyer who exercises would receive their strike price times 100 in cash and deliver 100 shares of stock. If they didn't own the shares and they were buying to speculate, that would leave them with a short stock position. Now, it's likely that investors don't want to have a short stock position, or may not even be allowed to have a short stock position in their account. So undoubtedly, this investor is looking to capture profit without exercising. In other words, what this investor is trying to do is to realize gains from the share price moving lower, which has a positive influence on the price of their put option. There are other factors to consider, such as the passage of time and possible changes to market volatility levels. But if shares move lower and they influence the price of the put to enough of an extent that the put buyer can sell for a profit, that's what they're trying to do, rather than exercise. Now, something else that the put buyer can do from a position management perspective is if their put option that they bought is in the money, if the shares have dropped significantly and this put is now in the money, one technique they can use is to buy shares instead of selling the put option. And this would be the circumstance if the investor has now thought that maybe the move lower, the share price decline is over, and the stock might start to bounce here and move significantly higher. Rather than exit the trade and sell the put option, this investor could potentially buy shares of stock and sort of lock in the intrinsic value of the put option. If there's enough time until expiration, they now have their position covered. They've locked in that intrinsic value, and if the shares really rallied in a significant fashion, they could potentially gain all of that upside without having any downside risk. They really now have backed into that two-sided position of long stock, long put, having started with a speculative position and ended up with those two pieces. That's what we want to focus on now with the protected put, is those two pieces, but more or less having done that, executed this strategy in the opposite direction. Here the investor is bullish on a stock, likely already owned, but is looking for protection against a downside move. If they buy the put option, they now have paid for the right to sell shares at a particular strike price, which can be considered a floor price, or the worst price at which they are allowed to sell their shares if they need to. And of course, they're going to pay for that. Now, there are alternatives to protecting a position outside of using a put option, which I will talk about when we look at the example, but this somewhat acts like an insurance policy. If you're familiar with insurance on a home or on a car, this is similar to that. Think of, first of all, the term deductible that many of you, I'm sure, are familiar with. The deductible of an insurance policy represents how much money or how much capital you have to give back before the insurance starts to pay off for you. In this case, you can think of the current stock price compared to the strike price or the floor price at which you can sell shares as being your deductible. Also, you're paying a premium, just as you pay a premium for an insurance policy. Now, in this case, the strike price, if you think about what a premium is, the greater protection that you buy, in this case, the higher strike price you pay for, the greater the premium is going to be and the more it's going to cost you. So this investor is constantly sort of toggling and thinking through how much protection do I want and how much am I willing to pay for that protection, thinking about those terms similarly to your classic insurance policies of deductible, the premium, and also expiration date. The decision on strike price and expiration date will be different from one investor to the next, and maybe even different from one circumstance to the next. Look at an example here, long stock at 80, and we'll just say most often as the protective put is added to an existing stock position that you bought shares here, maybe you thought 80 was a support level, shares were going to rally. You've watched the stock and it just hasn't rallied, just hasn't taken off. So you're sitting here at 80 wondering, what do I do now? Well, one choice of yours would be possibly to scale down your share position. It's an alternative to using a protective put. Scale down the shares and sell some of what you own to reduce your risk. You certainly could consider doing that. If you do, you'll have lower risk, but you also will have lower upside potential because you won't have a full-size position anymore. Let's look at this alternative, buying a put, and compare that to maybe something that you're thinking about right now, which is potentially using a stop loss. So we'll overlay this put option, buying the 75 strike put for $2.70, and see what that happens to our long stock position. That 270 is a cash debit. We're not going to get that money back. So to the upside, while we still gain and we still are bullish here, you have the parallel nature of gains between protected put and long stock, we underperform in the amount of this cost that we will not get back. That's an upfront cost. To pay that, we now have this benefit of downside protection where we can calculate our maximum loss. In this case, that deductible concept, 80 down to 75 before the protection is there. That's a $5 loss. We're also going to have a sunk cost of 270. So that's how you calculate your 770 maximum loss. Now, you might be thinking a stop loss here at 75 could work better because it doesn't cost anything, and that's true. Stop loss is not going to have a cost attached to it, but there's a few things to consider that are in favor of the put option. One thing is that the put option is going to work as protection in what I would say is more or less 24/7, round-the-clock protection. Overnight, over the weekend, a stop loss is not working for you, and if there's a gap at the opening of the next trading day, you are at the mercy of where the market opens, and the stop loss might get triggered at a level far below where you wanted that protection to be. Another advantage of the put option is more or less the psychology. So as I just said, the stop loss might not get triggered at your level, whereas the put option is going to hold your right to sell shares at 75 all the way through expiration. There's also this psychology effect. Those of you who've traded for a while, I'm sure you've been in this situation. You buy stock at 80, you set your stop loss at 75, the stock starts trading down 77, 76, and you're thinking, you know what, I don't really want to get out of this trade here. So you move your stop down to 72. Next thing you know, the stock's trading 74 to 73. You move your stop again. and then you think, okay, that's it. I can't move it anymore, and you're stopped out at 70. It's very easy to fall into that trap and somewhat move your stop loss down potentially far below where you wanted to get out of your trade. With the put option, much more difficult to do. It takes more work to go in and close the put option and then move it lower. So I think that the put places in a little bit extra forced discipline to the investor to get out of their trade where they would like to. For that, again, you're paying. There's a cost. And likely that cost is not going to be cheap. And at expiration, if you haven't used the protection, then you might have to buy puts again. So there's that cost element that you have to keep reconsidering. Now let's move forward and talk about covered calls. This is arguably the most popular strategy that gets talked about and utilized by all investors, beginners, seasoned veterans who use options. Everyone seems to use and enjoy the benefits of covered calls. There's risks that we're going to talk about here, but one of the unique things about covered calls is it has the ability or the potential to provide a little bit of risk management in addition to the possibility of increased returns. And normally those two things don't go together. When you think controlling risk, you normally think of giving up some reward. But with the covered calls, that's not necessarily the case. Let's take a look at what this strategy is all about. There are two sides to the covered call strategy. An investor writes or sells one or more equity call contracts for each 100 shares owned. And in exchange for that premium received, they accept the obligation to deliver shares at the strike price of the option. Now, what if you have a different amount than 100 shares? I often get this question of what if I have 50 shares or 75 shares? Can I sell a call option against that if I have less than 100? And the answer is no. The term covered really does mean that the obligation to deliver shares is covered by the number of shares you already own. So if you have 50 shares in your account and sell a call contract obligating you to deliver 100 shares, then you're not covered. So the answer there is no. And of course, if you have more than 100 shares, you can decide what you would like to do. If you have 500 shares, how many do you want to sell? 1, 2, 3, up to 5. And in exchange for that obligation, you take on premium. This is the reason for the trade. This is your goal. Why you're selling the call is to generate premium. That's yours to keep regardless of what happens later. This is in that category of income generating strategies over any dividends. I do have to stress it's still a neutral to bullish, at least bullish up to your strike price outlook on the underlying stock. Some investors that I talk to seem to fall into a trap sometimes of thinking that a particular options strategy just works and it's worked before, it's going to work again, and they do things over and over and over again because they've been successful at it. And there's nothing inherently wrong with having a strategy and using it over and over and over again. I'd just like to point out that this strategy will not perform well if the stock were to sell off significantly. And sometimes it just takes one or two really bad experiences to realize just how limited that protection the call option premium provides to the investor. So just keep in mind, as you re-implement strategies, it's this forecast that you need to keep consistent with the position that you have in your account. Now, let's talk a little bit more about the obligations that you undertake when you sell a call. Well, selling any option provides you with an obligation to perform a transaction in shares of stock with the calls the the seller has the obligation to sell shares at the strike price, and in this strategy, they're comfortable selling shares at that strike price if they're assigned. Now, equity and ETF options are American style. That's versus European style. Nothing to do with geography. American just means that the option can be exercised by the holder and therefore assigned to the seller on any trading day up to and including the expiration date of the option. Now, in the absence of dividends, there really isn't a financial incentive for the call holder to exercise early. They could exercise early if they want. It's totally up to them. They paid for those rights. But there really isn't a financial incentive. If they own a call option, stock price has rallied, and they're sitting on a profitable position that they would like to hold for further upside gain, they don't need to exercise the call to buy shares in order to further capitalize on upside. They can just hold the call option and continue to enjoy what they expect to be further premium increases in the call option that they own. Now, if this investor is done with the trade, the stock has rallied and they're ready to move on to something else. Again, they don't need to exercise early and buy shares to exit and capture their profits. They can just sell the call. That's all they have to do is sell the call option, exit the trade, and be done with it. Dividends is the circumstance that could change that. Remember, shareholders are entitled to dividends. Call holders are not. We all know that the share price is going to drop by the dividend amount, and that will occur on the ex-dividend date. So the call holder, particularly the in-the-money calls, will suffer if they don't do anything and the X date comes around, the stock drops, they will suffer the losses in their intrinsic value due to that dividend going X. So on the day prior to ex-div, if for in-the-money options, there is incentive for the call holder to exercise early. And as a call writer here, you have to be aware of that. When is the ex-div date? And you might get assigned just prior to that. Of course, the higher the dividend and the deeper in the money the call goes, the greater likelihood that assignment will occur. But all in-the-money options are subject, in that case, of dividends. In return for that obligation and that risk, you might say, of assignment, the call writer has been paid and gets to keep the option premium. Now let's look at an example of covered call. Here we have stock at 75, and similar to before, let's say you've owned shares at 75 for a little while, and you thought the stock was going to bounce here, and it's not happening. So you're starting to be a little bit concerned about where the share price is headed, and starting to lose confidence that a significant move higher is going to occur. So in this case, you choose to sell an 80 strike call option for $1.80. Now this does a couple of things for you. Here's your long stock at 75, clean break even right here at 75. By selling the call and receiving premium, your cost is reduced. It's not 75 anymore, it's 73.20. So your break-even point has been reduced. It's that risk management element to this trade. It's not a whole lot of risk downside protection, but it's $1.80's worth. It's a little bit of a buffer to the downside. So a little bit of protection here. And you can see to the upside, you will outperform shares of stock all the way up until this intersection. Now, where is this intersection? The maximum gain on the covered call, as we've written it here, is the stock moving from 75 up to 80. We're obligated to sell shares there. That's a $5 move. The option premium is ours to keep. That's $1.80. So $6.80 is the maximum gain of the covered call. Now, where would the stock position profit? $6.80, or $6.80 above 75 puts it right here. That would be $81 and 80 cents. That's that intersection. Above that level, then the covered call underperforms long stock. This is what I mentioned earlier, how the covered call has this strange dynamic where you're reducing risk by a certain amount. But given this range of stock prices, you're actually also potentially increasing your returns while reducing risk. It's one of the reasons why it's such a popular strategy. Let's talk for a minute about managing this position. To the downside, this is very similar to just managing being long shares of stock. How much risk tolerance do you have? How much pain can you take on this position before you feel like you have to take a closing loss on this trade? Very similar to this being long stock. Can you afford to let this thing go before you feel like you have to get out of it? If the stock were to consolidate right here around 75 and trade in this range, this is that circumstance where investors say, well, I'm just going to keep selling calls. The 80 strike expired worthless. I made $1.80 on it. I'm going to sell the 80 strike again. Or if the stock happened to rally a little bit, maybe it's trading 78, so your call expired worthless. Maybe you sell the 80s again for more premium, or maybe you go out further and you start to sell the 82s or 84s, and you keep selling calls. Very popular way to manage this strategy if the stock is consolidating or just slightly moving higher. Just, again, every time you re-enter that position, make sure it's consistent with your market outlook and make sure that it's not a smarter move to take what you've gained from the position and move on. Now, the upside is a little bit different here, managing the position. I want to talk about that a little bit deeper here. The reason why we're doing this trade, the reason why we're selling the call, is to capture the premium, specifically at the time value. When the time value goes to zero, the call does nothing else for us. That's the most we can possibly get out of the call, is when the time value goes to zero. It's obvious when the stock sells off and the actual premium is zero that we can't make anything more from this call. But for some investors, particularly those who are newer to using this strategy, it's a little bit less intuitive when the stock rallies. If the stock, say, goes to 90, we know that this option is in the money by $10, the difference between the strike and where the stock is. $10 would represent then the intrinsic value of the option. Anything above 10 would be the time value. So this is when you would want to track what is the option trading for. You go to your options chain, look at the bid and offer. If it's $9.90 bid offered at $10.10, and you can also look at the 80 strike put. If it's zero bid offered at a dime, then you know the call option has lost all of its time value. It's trading strictly around its intrinsic value. When you've reached that situation, then your position now has all risk and no more reward. When you're in that position of all risk, no reward, particularly if there's some time left before expiration, it's a good time to consider proactively exiting the position and moving your capital into something else rather than wait and hold for potentially days or a week or so and wait for assignment, because that entire time your money is doing nothing for you except taking on risk. To drive this point home a little further, let's say the stock was at 90 and you checked your options chain and it was trading, 1060 bid offered at 1080, midpoint 1070. The intrinsic value is $10. If it's trading for 1070, there's still 70 cents of time value that you would capture as the stock sits here at 90 and the option approaches expiration. That 70 cents is still potential decay that you could capture on your position, and you can evaluate that. Do you want to sit and hold and wait for that 70 to continue to decay, or do you want to proactively get out? But you want to track that. You want to see what the option is trading for as it's in the money and expiration is approaching. Let's take these two strategies, again, rather simple ones, and we'll sort of add a layer of complexity as we move into discussing the collar. Now, very simply, what I'm going to do is really just merge these two strategies together, the protective put with the covered call, merge them into one strategy that's called the collar. And on the upside, as we look at the profit and loss graph on our example coming up, it's going to look just like a covered call. And on the downside, the structure is going to look just like the protective put. Now, I'll point out that we are not doubling the share position. At its lowest denomination here, we are still long 100 shares, short one call option, and long one put. So it's merging the two, but not doubling the share price, the share quantity. At its heart, this is a risk-reducing strategy. The motivation here really is the downside put. And often I hear that this is a strategy used to attempt to slowly scale down a concentrated position in a portfolio while there is some downside hedge in place to protect against a large downside move. Let's talk about concentrated for just a minute to make sure we're all on the same page. The definition of concentrated really is simply that you had a particular position that is making up too much a percentage of your overall portfolio. It's carrying too much weight, and therefore, if that position were to sell off, or more specifically, if it just were to underperform the overall market, then you're carrying on too much risk because that one position is too large in your portfolio. Sometimes it's from the result of gradually building up a position over many years, continuing to buy shares of stock, and now all of a sudden that one position is really large. Sometimes it's the result of a very strong performing position in your portfolio. Your best performing stock, your best performing position, all of a sudden the dollar amount attached to that position might make up too much a percentage of your overall portfolio. That's what concentrated is referring to. Now, what percentage is too much? Well, that's a little more difficult question to answer. If you are very familiar with a company, you're tracking much more than just the broad headlines, but the day-to-day activities. You're tracking decisions and changes at the board and the executive level. You're familiar with its industry. You're tracking earnings reports of its competitors. If you're really, really in tune with the position that you have, then you might be able to tolerate a higher percentage than someone else, a different investor who tracks their investments more loosely, which is perfectly fine as well, but maybe a more loose, broad analysis of fundamentals and technicals. You might be willing to tolerate a different level regardless. And I think if you're up in that 40% or more with one position, I think anybody would consider that concentrated. But whether 30% is too much or 25 or 20 really depends on your familiarity with that particular position. But the collar sort of lends itself to that situation and the attempt to scale down at higher and higher levels to continue to potentially have upside potential while that put is in place to protect against a disaster that crushes your portfolio. The put is there as the priority, and the call premium offsets that cost. So if you want that put option protection perpetually over and over and over again, the call is going to prevent you from having to incur this cost over and over. So our example is going to look at out-of-the-money options, and certainly your strike prices on either side are going to determine where the exit levels are for the shares on in either direction. Long shares at 75, and we'll start there, assuming that that's where our break-even is, although most likely these shares built up over time, and if it's concentrated, you maybe own them from far, far lower than 75. But to illustrate the P&L, long shares at 75 are dashed line, this long stock. What if we do this options overlay, the traditional collar, buying a put option for $1.30, selling a call option for 90 cents, and taking on a net debit. Now notice we went equidistant from the stock price, and we paid a net debit. More on that in just a second. Doing so increases our break even by this small amount. Our cost is now going to be increased by 40 cents. And as I said before, on the upside, this looks like the covered call. We can enjoy share price appreciation up until we get to our call strike, and then we're obligated to sell. On the downside, we suffer losses in the amount of our deductible down to the put option strike, and then it's protected. If you do have that concentrated situation, you've got protection here against an adverse move in the share price. Ideally, your shares move up, but maybe not get called away. If your shares are moving up and you're enjoying nice gains and you've reached expiration, the stock's now at 80, then maybe you can implement another collar using higher strike prices. And that's really the benefit of the collar versus just straight out selling your shares and reducing your position. The collar provides that opportunity to get more and more upside out of your large position. And if you're interested in that, the collar might suit you a bit. I want to spend just a couple of minutes on this dynamic here of the premiums being different, equidistant from where the stock is trading. And this has to do with what we call volatility skew that some of you might be familiar with. And I will attempt just to draw a very simple version of volatility skew and some of its variations. The classic volatility skew looks something like this. And pardon my a little bit of inaccurate drawing here, not the most straight line, but here you have your implied volatility on the vertical axis. You have strike prices here on the horizontal. Here's your at-the-money level. And the classic, most common looking volatility skew that looks like this, where there's more demand for put options, particularly cheap, low strike puts that trade for very small amounts. There's not too much of an interest in selling those puts because of the risk attached to them. But certainly investors and money managers have an interest in buying those puts to protect against a big move lower, to improve their cost of capital. There's a few reasons why put options versus calls have demand. And because of that higher demand, that higher price, we have higher implied volatility levels for puts, and you have this shape of the skew that we have here. But I want to point out that the skew that we're seeing is not a rule. It doesn't have to occur this way. There are other skews that are potential, and I'll try to draw a few others in as best I can. That's not the best looking symmetrical skew there, but we'll draw a few more of these. Skew can take on any shape at all that it wants. And just to talk about these briefly, you could have more of a somewhat symmetrical looking skew here, where calls and puts are not too much different in their volatility levels. You might see this most commonly I refer to commodities, underlyings that might base their price off of gold, silver, maybe some grains and soft products, but the metals and oil, energies for sure. Those products that might move in either direction with just as much speed and velocity. There might be just as much demand for calls as there are for puts on those types of products. And then we have this inverted skew, where you have higher demand and higher implied vol levels for calls. Now, you would expect to see this in an underlying product whose moves to the upside were sort of inverse to where the market's going. Think about the VIX, for example. When the market crashes and there's a catastrophic correction, the VIX will spike to an extraordinary level. And because of that dynamic, the bid for higher strike prices, higher calls in VIX will be much greater than that in put. With VIX trading around 16 today, or if it trades lower to 15 to 14, there's not too much more downside to where the VIX is going to go. So those puts really don't have much value there. Now, for equities, they can take on any shape. This is most common, again, your classic common volatility skew, but equities really can take on any shape depending on the circumstance and the situation. I think over the past year or so, we've seen a variety of skews far more frequently than ever before. But our example in the premiums we've identified here, more or less your classic traditional skew, higher prices on puts than you have for calls. And if you're interested in the math, there is how you calculate your break even, say your share price plus the net debit, and then your loss and your profit as well. Now, as I mentioned at the top, strategies have this classic name, the traditional construction. And it's helpful to understand how those strategies are put together, but often that sets a foundation for your knowledge of a particular strategy and how it's used, how it's done. But when you're putting real money on the line and you're making a decision on what position you want in a live account, it is common to take your knowledge of how the strategy normally looks by definition and then change something about it and do something a little bit different. So it no longer becomes or is a collar. It's something that resembles a collar and looks different. And this is common across all different strategies. So let's take a look at a few possibilities and then discuss some collar variations. First, I'm going to look at what I'm going to call the staggered collar, something I get asked about on a regular basis. Buying longer-term protection, longer-term put options, and selling shorter-dated call options. And then the idea being to continue selling shorter-dated call options. Looks like the collar, but it's not your traditional collar, which uses the same expiration date. Now, what are the advantages and disadvantages of doing it this way, staggering the expiration dates? Well, first of all, an advantage is the faster time decay that you're going to enjoy from your short options versus the slow time decay that's going to occur on your long-term long option. Beta, or the natural day-to-day erosion of time value, begins to accelerate roughly 30 to 40 days out. You'll see different numbers here from different options educators, but we'll say roughly that 30 to 40 day area is where beta begins to accelerate. Now, if we buy a put option that expires in a year and we sell call options that expire in 30 days, then we're going to experience much faster decay on our short option. That's a good thing versus the long option. So what's the idea here? Ideally, in this situation, the calls go unassigned. The stock has either consolidated or it's slightly rallied but hasn't reached the strike price, and the call is left unassigned. So this investor can continue selling short-dated calls. If the stock were to remain unchanged and we sold 30-day call options, and we did that over and over and over again over the course of an entire year, then we should expect the total premium we received from the calls we sold to far surpass the cost of the puts that we bought that expired 1 year on the day that we bought them. But there are some disadvantages that we need to consider here as well. First, let's think of the initial position out of the gate when we construct this. The longer dated put option is going to have significantly more premium attached to it than the shorter dated calls we sell. So initially, that's a significant debit. And the risk profile of that first position is going to look less attractive than the traditional collar because we have a debit far greater that we need to make up. In effect, we have to keep selling shorter dated calls over and over again in order to make up for this longer dated put premium that we were willing to incur up front. Also, because of that initial debit, a large move in either direction would favor the traditional collar. Now, this concept might not be as intuitive, so I'll discuss it a bit. Before I do, it reminds me, one of the techniques that I learned when I was being trained and taught how to trade options professionally was when you have a concept you're trying to get straight in your mind and you're not quite understanding it, try to think of an example and then push that example to an extreme situation, an unrealistic situation. And then the answer starts to become more clear. If we think about the numbers we were using before, say stock at 75, and we're selling 80 calls, and say we're buying 70 strike put, what happens if the stock goes all the way to zero? And remember, in this case, we're staggering the expiration dates. If the stock goes all the way to zero, the calls would go to zero. That's good. But remember, we didn't get a whole lot of premium from those calls when we sold them. The put option is going to provide us protection in the sense that we can exercise and get out of this position at the strike price. That's good. The put option is going to go right to its intrinsic value and start trading at that level. All of its time value will also disappear as it goes deep, deep in the money. So when you consider those two things, the large debit that we incurred up front would have worked against us. We didn't get to capture enough option premium by selling premium to overcome that large debit. So a large move lower would greatly favor the traditional collar construction versus this staggered version. Similarly to the upside, if the stock, say, went all the way to $200 a share, the put option goes to zero. We paid a lot for that put option. It goes to zero. The call option's deep in the money. We're going to get assigned. The position's going to get taken out. And again, we paid a lot for this staggered version versus the traditional collar. And it would underperform. Always have to consider the advantage and the disadvantage of doing these different variations. We move to another variation of the traditional collar. And this one we're going to call the put spread collar. Now, your standard collar provides protection all the way down to zero. Remember, you buy the 70 put, you have protection all the way to zero. But you might feel as though you don't need all of that protection. It's almost like buying too much insurance. So if you wanted to add a bit of complexity here, it might be possible to reduce your cost or increase the credit by selling a further out-of-the-money put. Also, you're adding a layer. So now you'd have four positions: long stock, short call, long put. That's your traditional collar. And then you add to it a short, further out-of-the-money put. The net effect here is that you're giving up the insurance at the strike price of the put that you sold. And you might be comfortable with that, and the premium received from that short option might make it worth your while. Let's take a look at an example. And here, long stock from 105, and we'll say that you have enjoyed some gains. Stock is currently trading up to $120 a share. And now you've got your options overlay. You can see the two pieces: sell, call, buy, put. There's your traditional collar. And then you add to it the sale of a lower strike put, which we're going to look at a P&L graph here in a second. That's going to have the effect of improving the credit debit of your options piece, but at the same time, it's going to eliminate protection below that strike price. Now, this might be hard to visualize, but also one of the things that I've always felt was productive efforts when it comes to thinking about a strategy, particularly if you're doing something unique and trying to evaluate what does this risk profile look like? What exactly am I doing here? And that is to construct for yourself a graph of profit and loss at various stock prices, and then translating that into a visual. I'm not going to walk through all of these numbers here, but I will say this is a healthy exercise to know how to do it. Simple arithmetic. Choose stock prices at expiration, calculate the profit and loss of your various positions, and get to a net number. It should be very simple to do that. Just what's the value, profit and loss of the stock position, and what's the profit and loss of the various options. What you'll certainly want to do is when you choose your stock prices, is you'll want to choose your strikes here. So you'll want to have these three numbers, 105, 115, and 125. You'll want those to be there. And then you can go outside of those numbers. You can even go in between the strikes as well to be more thorough. You create this kind of a graph, this chart. Now you've got your stock price at expiration attached to a P&L. You can take these numbers and turn them into these risk graphs that we keep showing you. So this is useful if you're doing something different, doing something a little unique, and you want to figure out for yourself, what exactly am I doing here? And as we look at this put spread collar, we said the stock's up here at 120. So we're already profitable. On the upside, this looks like the covered call. We're going to sell shares at 125, and we'll be out of the position there. If the stock were to sell off, we've got protection at 115. We bought shares at 105. At 115, we're up $10. But because we sold this extra put, we actually turned it into a credit, an overall credit. So we're actually up $11 at this 115 strike if the stock is there. We're protected because we own the 115 put all the way down to 105. At 105, our position would still be up $11, $10 from the protection here that we were afforded, plus the credit. So that's still in place, locked in $11 gain. As the stock drops, where do we give up those $11? Well, 105 minus 11 puts you at 94. And that's where your break even is. So this is how that would all look on a P&L graph. Lots of moving pieces here. And as I said, constructing that graph on the previous page is really done by choosing your strike prices and then calculating P&L and simply connecting the dots. Position management might be a little more complex here with the different parts, but again, similar type position management technique as we've discussed before, with covered calls on the upside and that protective put looking risk to the downside. And then the last variation I wanted to walk through today is this laddered collar, buying a put long term, and then instead of just deciding to sell all short-term calls, you stagger the expiration date of the call options, and in addition to that, you stagger the strike prices of the options. So let's take a look at that. In our example, stock's trading 100 along 500 shares of stock, and we go out quite a bit of time here, 180 days to buy 85 puts for $4 each. So we've covered all 500 shares with protection on these puts. And now we go out in time. This is, for example, I'll talk about these long expirations in a second, really for illustrative purposes. We go out in time, but no further than the length of our put option, no further than that. So all within the 180 days. And we choose various strike prices and sell them in whatever quantities we want. We can sell 2 here or 2 here or anywhere. We want to stagger the quantities. And so now the put option, your choice of strike price is going to determine what kind of debit you have here. In our example, there is a debit because, of course, we went out and bought all 5 very long-term and sold some of these short-term. But now since we were able to go out in time and go up in strike price, you can see with the stock at 100, our final shares are not going to get called away until we're all the way up here at 120. That's a nice big move. So we're sort of scaling out the position gradually as the stock moves from 100 and moves higher and higher. I mentioned these long expirations. I also mentioned time decay earlier at 30 to 40-day level. It's not likely that you would want to be going out 180 days to sell your calls because this decay would be so slow. You'd likely move this in closer, maybe even drop the strike price a bit to get decent premium and move it in closer to that 60-day level. But I wanted to showcase here that the latest dated option you would want to have would be equal to your puts. And that comes more to fruition as you're approaching expiration, and this 180-day put becomes 90 days and becomes 60 days and becomes 40 days. If you're able to keep selling calls, you'll want to make sure you're not going out further than whatever the expiration days to expiration is for your put option. This strategy here, a great benefit. You can enjoy much more share price appreciation before your shares are called away. That's a big benefit. You also might have to deal with more position management as your shares might get called away, and now you're down to 400 or 300. You start to look at the puts, and maybe you start to sell one or two of the puts if there's value there. If you're not called away on your options, you decide, what do you want to do? Keep selling calls, change the strike prices, keep the strike prices the same. A little more active position management might be required here, which is not abnormal for those of you that use options and use them extensively. It's not the type of product that you set and forget. In sharp contrast to that, options traders are managing their positions, they're watching the market, and they're determining constantly what the next best move is for them and for their position. I'm going to leave up our contact information again. There was a lot that I went through, so if you have questions about those variations and the different things that we talked about here today, I hope those variations didn't confuse you too much, but if you do need some further clarification on a few things, please send an email to our team, options@theocc.com, and we'll be happy to help you out as best we can. Check out our website, the various forms of education that we have up there. Our YouTube channel gets the archives of all of these webinars that we do on a regular and constant basis, and also materials that we're highlighting on our social media, Facebook and Twitter as well. So feel free to reach out to us, check out our website, and follow us on social as well as much as you can. Last thing, before I let you go, to please take the survey attached to this presentation here today. We look at all of the feedback that we get, all of the suggestions that come through for topics. We review those, and it helps us shape and tailor the program moving forward to the way that the audience would prefer to see it go. So again, I want to thank Mark and Ken for answering the questions as we went through. Thanks everyone for attending here today. Hope you enjoyed the session, and we will see you hopefully registered for our next event coming up in August. Thanks again, and enjoy the rest of your evening.